this is where a cost segregation firm comes in. If you do not get a cost seg study, you just either straight line depreciate it over 27 and a half years or 39 years.
Okay.
However, what we do is we help you accelerate that depreciation. So
Oh,
rather than having $10,000 every year, it's a time value of money tool. We front load the depreciation. So we do an engineering study and we break down the building and we say, hey, IRS, like actually not everything, is 27 and a half years. Some of it will be five years, some of it 7, some of it 15. And a big chunk of it, we can expense out in year 1. So the idea is that rather than waiting or 30 or 40 years to depreciate your property, you get the majority of the benefits in year 1, and really almost it's kind of the first 5 years are extremely beneficial for cost segregation.
Hi, I'm Zorina Dimitrova and welcome to the Grow and Learn podcast. Here I host thought leaders on business growth, transformation, leadership, and succeeding in life and business with a human focus. At Grow and Learn, we are the only ones offering uniquely customized solutions to business needs using a cutting-edge AI business growth assessment tool and a global network of top-tier experts to craft and execute strategies that drive impactful results. If you're ready to grow smarter, book a call today at growandlearn.org and let's transform your business together. Enjoy this episode. Speaking real estate today, real estate and accounting, how to make real estate more profitable. If you're in this industry, stay tuned. I'm speaking to Sean Graham, CEO of Maven Cost Segregation. I have no clue what we're going to be talking about today. I'm definitely curious of how we can make real estate more profitable. Welcome, Sean.
Awesome. Yeah, thanks, Zorina. Thanks for having me on the show.
My pleasure. Sean, I read your story. I know you dropped off your regular CPA job at a company. You just dove in real estate fixed storage. Is that correct?
Self-storage. Yeah.
Self-storage.
Yeah, I can give you a little bit about my background if you'd like.
Please.
Yeah. So my background is as a CPA. So I was doing tax work. So I went to school, got my bachelor's, my master's to do accounting and tax. And so that's what I originally went into. Many steps in between, from going from being in tax and accounting to owning and running my own cost segregation firm. There's a lot of steps in between there. And so I went through different jobs. I was in public accounting for a little bit. I was in a private equity backed company, doing a lot in finance and accounting there. And then I dove into real estate myself. So I started investing in real estate on the side. Like I started buying residential, small residential multifamily properties, buying those, renting them. And I really got the real estate bug, so to speak. Like I just loved the asset class. And I knew I wanted to be an entrepreneur. So it was kind of, what's the best path to become an entrepreneur? And real estate offers like a pretty clear path. So as I started building up residential rental properties, eventually I got into self-storage, and I went full time into self-storage facilities. So essentially, as buying existing facilities, you're really renting sheds, so to speak. They're roll-up doors, they're metal buildings.
Yeah.
People store their stuff in them. They month-to-month rentals. But there's a lot of control in the asset class, meaning you can control how you operate it. You can control pricing. It's kind of dynamic, almost like an airline where like you can change the price of the ticket. You can change the price of the rent, up and down. And I like the idea of having control over the net operating income from that perspective and really being able to control the value of the business. I eventually realized there's a lot from the accounting side that I need now that I'm in real estate that was like on the tax and accounting side. And one of those things was cost segregation. So I was able to bridge the worlds of being in tax with real estate and with this cost segregation firm. And that's really my main focus now. And so essentially what cost segregation is, it's a way to help real estate investors minimize their tax burden and maximize their cash flow. So the way we do that.
Can you give us an example of what types of costs, like if we can drill down a bit deeper, and does it only apply to storage facilities or does it apply across different real estate asset classes.
Yeah, it applies to any real estate. So it's like it's not about whether it's self-storage or not. It just has to be an investment property. So if it's like the house you're buying to live in, you don't do a cost segregation study on it. But if it's a rental property, or maybe you were living in a property, you convert it into a rental later, you move out. It could be commercial real estate, residential real estate. And so the IRS allows you to deduct depreciation on it allows you to depreciate the property on an annual basis. And so what that means is it says, hey, like buildings, they have wear and tear. Now you buy something as wear and tear. And so we're going to let you kind of expense out the wear and tear on an annual basis. And so it's really this phantom expense. So let's just say you have a $275,000 property. Okay, over 27 and a half years, you get to depreciate $10,000 every year, which really means, hey, you're lowering your tax burden by $10,000 every year. That's great. But it's not
May I
like
ask you a question? Because depreciation is a relatively basic thing. Isn't this done normally by accountants in the US? Like deduct is like a basis of accounting to
yeah,
deduct
so
depreciation.
this is where a cost segregation firm comes in. If you do not get a cost seg study, you just either straight line depreciate it over 27 and a half years or 39 years.
Okay.
However, what we do is we help you accelerate that depreciation. So
Oh.
rather than having $10,000 every year, it's a time
Mm-hmm.
value of money tool. We
Mm-hmm.
front load the depreciation. So we do an engineering study and we
Mm-hmm.
break down the building and we say, hey, IRS, like actually not everything, is 27 and a half years. Some of it will be five years, some of it 7, some of it 15. And a big chunk of it we can expense out in year one. So
Mm-hmm.
the idea is that rather than waiting or 30 or 40 years to depreciate your property, you get the majority of the benefits in year one and really like almost like it's kind of the first 5 years are extremely beneficial for
Oh,
cost
that's
segregation.
fantastic. Yeah. Okay. Okay. And so what kind of, I don't know if you're willing to share what kind of
Sure.
costs particularly can be depreciated upfront with this accelerated depreciation scheme.
And so it's the whatever you buy the property for, less the value of the land. So if you let's just say you bought the property as I said earlier, like $300,000 and the land's worth 25,000. Okay, well now you have $275,000 basis. And if you don't do a cost seg study, like just an accountant, how they do it is they would just say, okay, $10,000 every single year, straight line depreciation. With the cost seg study, we're able to get a big chunk of that right up front. So let's just say you get a 50, $60,000 write-off in year one, and then year two, maybe like a $20,000 write-off. And then year three, four, it starts going down, right? But it's really front loading that depreciation. So it's kind of, if I said, Zarina, like if I could give you a dollar today or a dollar in 30 years, what would you rather have? You'd say, well, I'd rather have the dollar today, right? A dollar today is worth a lot more than a dollar in 30 years. And that's essentially what cost segregation is about.
Yeah, my question was more like whether you can share with us the type of designation you assign a portion of the building to, so that you can up
Sure. Yeah.
uh, upload
Absolutely.
this amount or the chunk of the depreciation at the beginning.
No, that's a really good question. So the IRS defaults the building into, I would just say, let's say structural components, right? And so structural means like long-term permanent, right? So you're talking about the foundation, the roof, the walls.
Uh-huh.
So everything like defaults to that long-term life. Um, and so with a cost segregation study, we reallocate a portion to, let's just say part of it is land improvements or site improvements. So that's the stuff outside. So we're saying like, hey, the driveway, the fencing, the landscaping, the sidewalks, all that, that's not part of the structural components. Like that can be accelerated. That goes into 15-year life, but a big portion that's eligible for bonus in year one. And
Mhm.
we say, okay, inside the property, non-structural, we'll say like carpeting or laminate flooring, appliances, light fixtures, kitchen cabinets, things like that. That's all non-structural. Like we could like, it's we could remove these things and the building is still there. The
Mhm.
structure is still there, right? It's like
Mhm.
it works as a functioning building. Like plumbing, stuff like that, like not so much because you have to go under the floor, you have to rip up flooring, things like that, right? Like that's more structural. But things that can be removed more easily, those are the things that are non-structural. We move to 5-year life. Again, eligible for bonus depreciation in year one too.
Hmm.
Um, and then for like let's say Airbnbs or short-term rentals, the furnishings. So any furniture that can like get moved into 7-year life. So these are the types of things that if you don't get a cost seg study, you're going to wait, it's just going to go in straight line. It's going to be part of that structural group. It's going to be 27 and a half years or 39 years, depending on the asset class. And with a cost seg study, those are the type of items that you're going to be able to accelerate and get a big deduction in year one.
Yeah. What would you say is the ratio to these fast depreciating items to the rest of the value of the building for a residential building?
I would say, I'll give you maybe give or take around 30%
Hmm.
typically gets reallocated. Now, that's not including land value. So we're just talking
Yeah.
about,
Yeah.
like exclude the land value, but I'd say sometimes it's 20%, sometimes it's 40%, but give or take somewhere around that 30% range. And again, it depends on the type of asset class. Like let's say mobile home park. Mobile home parks, they're not structural, right? Like they're all movable items and stuff and
Yeah.
movable like homes. That can all go to a 5-year life class. So like
You're
that the
basically
major
depreciating a car.
right, exactly,
Yeah.
exactly. Yep. Yep. So yeah, it would be like depreciating a car. So it depends on the type of life class, but when we're talking about like residential buildings or residential homes, somewhere around 30%, give or take.
Yeah. And what could you potentially depreciate in this accelerated way for the business where you're invested in right now, the
Self-storage?
storage, the self storage?
That's a good question. So the walls, right, and the doors, those are all like that's like the outside doors. Let's say you have a drive-up self-storage facility, that is part of the structural components because if you remove the door, well, then there's just a hole in the building, right? So that's part of it. But when you have an indoor self-storage facility and you walk inside, well, the indoor units, the doors, like those can be removed, right? And the building's still there and structural, so like that can be reallocated. Lighting inside. You have partition walls, so like the walls that are non-load bearing in
Yeah.
between units,
Uh-huh.
we can allocate cost towards those. Everything outside as well, like, driveway, fencing, sidewalk, pavement, that sort of thing. That's all can be reallocated. So,
Yeah.
um, essentially, the more complicated the building is, the more there is to reallocate.
Yeah.
The more simple it is, the less there is. So, like, think of a warehouse. Like, there's nothing inside the warehouse. It's essentially
Yeah.
a shell, right? Like,
Mhm.
you're not going to get a ton of depreciation benefits from it, but um, an indoor climate controlled self-storage facility with lots of, halls and units and stuff like inside, we're going to be able to reallocate a lot more on that.
Yeah. Sham, did you come up with this solution for cost saving yourself, or did it
I
exist?
wish. No, I
Yeah.
wish. Yeah. So it's like it's sanctioned by the IRS. So the IRS, the Internal Revenue Service, they say, hey, actually the correct way to do this is to get a cost segregation study done and to reallocate these asset classes. So that's actually the what you are supposed to do. The incorrect method is just to default it all to structural items. So I just I guess I come at it from a different angle than what most people come at it as. And so what I mean by that is like I'm a real estate investor myself. So like I understand like what the goals are. The goals really are to get as much depreciation as possible to offset your taxable income, to show no taxes and not, don't have to pay any taxes. And the government incentivizes you to do that. But from the tax side, the CPA side, right? Like I also understand what they're looking for. And so it's like there's some, I guess I won't talk about anybody specifically, but like you don't want to go to a firm that's going to like just be way out of line, right? In terms of like they're super, super aggressive and trying to depreciate everything or things that are
Yeah.
not
Mm.
truly or like truly accurate, right? Like you don't
Yeah.
want that either. And so I try to meet this in a middle ground of understanding both sides, um, and be aggressive, but in an honest and ethical way.
In a compliant way, at least.
Compliant way. That's a great way to say it. Yes. Thank you.
Fantastic. How does it look? How does this segregation look like for real estate developments?
Well, real estate developments, you can often get a lot more because you know exactly what, like, it's going to be more accurate, right? So, like, let's just say if you buy a house or you buy a building, um, well, you don't have the individual line items for every single component, right? Like, we're essentially we're doing detailed engineering, but we are, it's more of an estimate, right? And it's allocating the purchase price among all the different components. Whereas like if you have the actuals and you have the line like itemized line items, well, we're able to pull out every little thing in an accurate way, right? Like because we know exactly what it was for. Now, some general contractors are more detailed than others, right? And so it depends on like how detailed you are from our work standpoint as to whether we can do that or not. But I think with developments, idea is like if you talk to us before, then we can kind of suggest some ways where it's like, hey, we can actually, if we plan it this way, or if we use certain materials, or you work with certain people, like there's energy credits, there's ways to get like more out of it, like basically be able to have more go to non-structural than structural, right? Like to maximize the depreciation. So like from a planning perspective, it's like it's good to have a conversation before you go ahead and build everything.
Fantastic. And normally depreciation starts being deducted after the completion of the project. Is there a way with the segregation method that you're using to start depreciating before the completion of the real estate project?
No, great question. It has to be placed in service. So
Uh-huh.
placed in service means that I would say it's either the earlier of either like the day it starts renting, or let's say it was available to be rented and you were advertising it to be rented. So like if you start advertising today, right, on February 25th for a March 1st move-in, well then March 1st would be the in-service date, right? But like if you start advertising today to move in today, well then today would be the in-service date.
Yeah,
So it needs to be available and marketed.
yeah. Who do you normally serve? You currently hire 10 virtual assistants. What does the structure of your company look like? You managed to grow it significantly with overseas staff as well. What kind of clients do you engage with, or who do you serve best?
We do a lot of, yeah. So I work with people from all over the world. So I have a strong team, people all over the world, including U.S., Philippines, Egypt, South Africa. Uh, but I have people who work with me all over, and so I like utilizing global talent. That's been really good for me, myself and my businesses. That's how I run everything, my self-storage facilities, all of it. Um, we work with US investors. So US real estate investors. We do a lot of residential properties. So people who, we have like a really good package, really good opportunity for doing detailed engineering work for like single family home, residential, duplexes, triplexes, those type of investors. But we also do a lot of self-storage facility owners. We do hotels, we do strip malls, we pretty much do everything commercial side as well. So it's always good if you are like it's good to connect with syndicators, real estate syndicators who are putting together deals to work with them and like kind of help them from the front end and say so they can show their investors how much depreciation they'll be able to pass along to their investors. And it's good to just work with small residential rental property owners as well.
Mhm. Okay, fantastic. Very interesting business model. What else can you tell us about developing a business? How did you launch it? You basically started with no money out of pocket. How did you manage to develop it to such a size?
Oh, yeah, I mean, most of the things I've done, I haven't like, it's more about like Going out and connecting. I think a lot of this, like the highest and best use for myself is connecting with people. So it's networking, it's connecting. And I mean, this kind of sounds a little maybe obvious, like, yes, you want to be connected to people, but essentially, like, I didn't start, I started off in many different things, right? But like, they all kind of led into each other. So, with real estate, it's very entrenched in the residential real estate market, as well as the self-storage real estate market. So that allowed me to, when I had a different type of a business or going with the cost segregation firm, right? Like those connections, like really, they translated over because I was already in that group, right? Like I was already an investor and stuff myself, very well
Mhm.
connected there. So like that has worked very well. I forgot, sorry, I forgot what your original question was or if I answered it.
It was more about how you put things together, but you answered the question
Okay.
fantastically, so no need to go deeper in that. I was just wondering because you mentioned you would advise individual real estate investors to go and check out the depreciation of syndicates. Do you work only with larger projects like syndicated projects, or do you also work with individual real estate,
No,
residential,
I work with everybody. If
with
you're a
everyone?
real estate investor, then like we have an opportunity for you. So there are cost seg firms that like they're really catered to like large commercial real estate investors. And we work with large commercial real estate investors, but we also work with a lot of just small real estate investors who are
Yeah.
just buying. We do a lot of short-term rentals, like a ton of short-term rentals, and most of those are owned by individual people.
Hmm. Hmm. So your website is Maven Cost Segregation. I opened it and I saw that you're offering a free, like a form where you can have a rough estimate of the segregation uh,
Yeah, yeah.
savings.
So
So
if you,
what
I
is it?
actually created a link for your listeners, like
Mhm.
if they want to check it out, I could give it to you. You could put it in the show notes.
Yeah.
So it's mavencostseg.com/grow, as in, your podcast, Grow and Learn. But if you go there and you fill out a form, then when I'll know you came from your podcast, Arena, but also we'll get you an estimate on your property. So if you give us your property and they say we're going to want the address, the purchase price, maybe any capital expenditures you spent, some photos when you placed it in service. We need to know if it's a short-term rental or not, but it's really basic information, and we'll help you with that. But collect that information, and then we'll get you an estimate on the property, and we'll say, hey, like based on your particular property, our engineers believe that you will get, X amount of depreciation in year one and year two, and we'll show the full depreciation schedule for you, and then also kind of give you pricing for the those like for the study itself as well, right? And so you can kind of see like, okay, well, this would be my return on investment and decide if it's worth pursuing or not.
Mhm. Can this be done retroactively once you've submitted your IRS filing, and then once you do the segregation, can you do it retroactively for previous years?
Yeah, definitely. It's called a Form 3115. So it's a change in accounting method. So let's just say you bought a rental property in 2020 and you've just been doing straight line depreciation. Well, we can do a cost seg study, let's say for the 2024 tax year, and we say, hey, IRS, like we did like, okay, we were using the incorrect method of depreciation, just doing straight line. We did a cost seg study. Now we're using the correct method of depreciation. We're accelerating it all. And so we missed $100,000 of depreciation over these prior, 3 years, 2020 through 2023. We're going to take all of that in 2024
Mhm.
plus, the 2024 depreciation amount. And you can do that for properties that you've already placed in service. So
How
um,
many years back can you go?
there's no limit,
No.
but I would say it's very beneficial in the first 5 years still.
Yeah.
The first 15 years is still going to provide a benefit. After that, it starts fading out the benefit. Uh, there always will be a benefit always to like the last year because you're front loading it, right? But it's I would say like
In
you get a
industry,
lot of
yeah.
benefit in the first
Yeah.
5 years because we reallocate things from like into 5 year life
Yeah.
class or 15-year life class. So that's
Mhm.
why I would do it within those time periods.
Mhm. Great service. Once again, can you mention the link?
Yeah, so it's mavencostseg.com/grow. And if you fill out a form there, I'll put a discount for your listeners, Zarina, and then we'll know they, came from you, and we'll go from there. And you submit a form, and then we'll get an estimate for you right away, and um, get it all set up for you.
Thank you so much for the detailed breakdown. I don't know if other podcast hosts are digging that much deep, but
I
I'm
like your
personally very
questions. You have
interested.
very good questions. Yes,
Yes, I like to know the details. Thank you
that's
so much.
great.
It was very, very interesting to me.
Awesome. Thank you for having me.
Thank you for listening to Grow and Learn. We hope that you found our podcast informative, engaging, and inspiring. Our mission is to help you keep growing and learning, and we hope that our conversations and insights have provided you with practical advice and useful perspectives. If you're looking for personalized support and guidance to help you achieve your personal or professional growth objectives, I offer a range of services to help. As a trusted management partner and mentor, I work with businesses in the process of transformation, looking for new streams of business as well as M&A. With an extensive professional network of experts and mentors, I can bring on board the right person or team based on the specific needs of the company I'm working with. To learn more about the services I offer and how I can help you achieve your goals, please visit my website at growandlearn.org. You can also reach out to me via email or social media. I'd love to hear from you. And if you enjoyed this episode of Grow and Learn, please subscribe to our podcast and leave us a review. Your feedback is important to us, and it helps us to continue to create content that is relevant and valuable to our listeners. Thanks again for listening, and we look forward to sharing more insights and perspectives with you in the future.